Hello and welcome to my YouTube channel. I'm Safir Ahmed, a senior lecturer in accounting and finance in a UK university. I also work with ACC as an early career ambassador. This video is relevant if you're currently studying financial accounting, preparing financial statements as part of your AAT level 3 financial accounting module, financial accounting unit. In this video, I'm covering the task 5, so which is mainly theoretical in nature. So it's all about accounting principles, also known as accounting concepts, qualities of useful financial information. So remember, there are two fundamental qualitative characteristics, qualities, and there are 4 enhancing qualitative characteristics, as well as interpreting financial statements using profitability ratios. Now, this topic is, as you know, is new at level 3. So there will be something in relation to that. So normally is calculation of ratios as well as interpretation of ratios. So as a yes, no, or, whether true or false, that kind of question. So part A, identify the principle being described in each of the following scenarios. The first one is value of goods sold but not yet paid for the year end is included in sales for the year. Now you can see that this is all about accruals concept, that we record the transactions in the period when they incur, in other words, that the period that which they are related to, regardless that whether we have received the money as yet or not, or whether we have paid the money as yet or not. So therefore, this is a description of that accruals principle. The next one is Rena owns a greetings card business. When she takes a card for her own use, she records this as drawings. Now, remember, this is in relation to the business entity concept, the way we separate owners from business. So we are not recording this as an expense. We are recording it as a drawing because it's the owner has taken the goods out of the business. So this is, of course, business entity concept. Stationary items such as staplers are treated as expenses rather than non-current asset. Now, the nature of stapler is of a non-current asset because businesses normally use it for more than 1 year. And technically, that's the definition of the capital expenditure as well. But because of the amount is immaterial in nature, so therefore we are not going to record it as a asset and depreciate it because of the small amount. So therefore, what we do instead, we record it as an expense. So therefore, that this is materiality concept, that due to the immaterial nature of stapler, we will record them as expense rather than non-current asset. Or in other words, that revenue expenditure as revenue expenditure rather than capital expenditure. Non-current assets are depreciated. Now, one of the principle is accruals principle, of course, but there is also another principle here, which is of course the going concern principle. As how that going concern principle is relevant here, because we are recording the non-current asset at carrying amount or the net book value, in other words, the cost minus accumulated depreciation. So why we are recording, why we are depreciating, and why we are recording it at the current carrying amount rather than the expected selling price of those non-current assets? Because we are assuming that the business will continue in the foreseeable future, so next year as well. So it's a continuing value rather than the expected selling price. So two principles are relevant here. So one is, of course, accruals principle as well as going concern principle. Next part, identify each of the enhancing qualitative characteristic being described below. So remember, there are 4 of them: verifiability, understandability, comparability, and timeliness. So when knowledgeable and independent observers can reach a consensus that the information is faithfully represented, which means that the information is verifiable. So this is verifiability. When information is clearly and concisely classified, characterized, and presented, this does not mean that complex information should be excluded. Now, this is they're talking about understandability. The information is presented clearly, but it doesn't mean that complex information will be excluded. It will still be included. But what this characteristic is all about is that um, not making information as ambiguous. So it's kind of clearly presented. So it can include, of course, all of that complex information, depending on the assets, depending on the transactions, in other words, for a business. So, of course, this is your understandability characteristic. Identify whether the following statements about profitability ratios are true or false. So let's have a look. The interpretation of an entity's financial statements using ratio is only useful for potential investors, and we know that this is not true because it's useful for any users of financial statement, depending on what type of decision they will be taking. So including existing investors, management, and if it is a company, remember board of directors, for example, and also lenders, banks. It could also be HMRC. So any other, stakeholder, any other user of financial statement, it can be useful for them as well. So therefore, this is false. This is not only useful for the potential investors, but actually that is useful to the stakeholders or the users of financial statement. In order to provide useful information, ratios need to be compared to different organizations, different time periods or industry standards. That's true because a ratio on its own doesn't mean anything. So if I say to you that gross profit ratio is 40%, is it good or bad? We don't really know unless and until we have a comparative figure. So maybe the gross profit ratio last year was 30%, this year 40%, then it becomes meaningful for us. Or the gross profit ratio as compared to industry average is 10% higher. It becomes useful. A disadvantage of ratio is that they are based on previous performance, which may not be valid for making predictions about the future. That's correct. Think about pandemic. During pandemic, which businesses would have predicted that? It's very difficult to predict, isn't it? So therefore, one of the disadvantages that is it can be irrelevant in that sense, despite the fact that it is useful in majority of the cases, but in some cases that it might not be relevant anymore because it's based on the past transactions, past data. It might not be relevant now. So of course that this is true. All other things being equal, if gross profit percentage increases, then net profit percentage will decrease. Well, technically that will increase as well. So of course this is not true, because if the gross profit percentage increases and everything else remains same, then of course the net profit percentage will increase as well. Now, this is, you're given the following information about an organization, and all we have to do is we need to calculate the following ratios based on the information above. Answer should be given to 2 decimal places. Now, I was just checking if this information is given as a reference material, but I cannot see it there. So which means that we will have to use this information. Okay, calculate the following ratios based on the information above, and answer should be given to 2 decimal places, so which will be doing that. Now, the first one, which is return on capital employed. Now, you got to remember the formulas for these. Return on capital employed is profit before interest and tax. In other words, operating profit divided by capital employed, and capital employed is the non-current liabilities plus the equity plus the capital. So what I will suggest that you need to do first of all is adding non-current liabilities and capital together. So you have the denominator figure. Okay. So if we add those two together, 97,500 plus 136,400, which gives you 233,900. So that will be the denominator, 233,900. And the numerator will be the profit. Now it will be the operating profit, but as you can see that they have not given you profit for the year separately and then operating profit separately. So we will assume that the profit is your operating profit as well, which is 59,160 and divided by 233,700. And sorry, let me double check that again. Denominator will be 136,400 plus 97,500, which is 233,900. So the top value will be 59,160. In other words, numerator divided by denominator will be 233,900 and times by 100. That gives you 25.29286. So remember, up to 2 decimal places, it will be 25.29. And then net profit margin, the formula for net profit margin is profit for the year divided by sales times by 100. So the profit for the year is 59,160 divided by sales revenue, which is 423,700 times by 100. And that gives you basically 13.9627. So of course, up to 2 decimal places, it will be 13.96. So for ratios, there are not too many ratios. So you got to kind of remember one way or another the formulas, maybe by practicing as many questions as you can, or but one way or another, you got to remember the formula. I think net profit margin is kind of straightforward. In other words, net profit for the year is net profit anyway, divided by sales. Revenue, return on capital employed. Capital employed is basically long-term finance. So capital employed will be non-current liabilities plus capital. So you'll be just adding those two figures there. And then I think if you put those values in that formula, you can calculate any ratio. Those ratios, of course, but there can be other ratios. Shop wages as a percentage of revenue has risen from the previous year. So what they're saying is that the percentage of shop wages, in other words, that this expense in terms of percentage has increased from previous year. Identify whether the following statements about the rise in the ratios are true or false. The first one is that the rise could have been caused by the business taking on a new person in order to stimulate growth. So if you think about it, that if wages and salaries will go up without any rise in other things, then of course that the percentage will be the rise could have been caused by the business taking on a new person in order to stimulate growth. So of course that the percentage will be higher. So in other words, that if wages will be higher, the wages as a percentage of revenue will be higher, provided that there are no other changes as well. So as you can see that this could be a reason. Let's look at the second one. The rise could have been caused by revenue rising during the year due to increased advertising. No extra staff were employed in the shop. So again, that got nothing to do with the wages itself. If the revenue would have been higher, then if the revenue would have been higher, basically, it will have an adverse effect on the wages as a percentage. But that's not the case here. Okay, so therefore, that this will be false. Okay, thank you for watching. I will be back with other videos.